with other techniques and indicators, and basically it is about price structure using moving averages in the Forex market. So this first one here, the black line, that is the 15 EMA, exponential moving average. And then this next line, the red one, is the 50 period simple moving average. And the yellow one here, or maybe it's orange, kind of a yellow-orange there, and that is a 100 period simple moving average. And then the purple one is the 200 period simple moving average. So those are the four that I use, and I've been using them for years, and they work really well. So let me show you how I use these, how I read them, and so forth. So the ultimate challenge and solution is whether the market actually responds to these levels, of course. So basically what I'm looking for is the 50 period simple moving average that I use as my line in the sand between a bull and a bear market. So if we're above it and it's angling up, I consider that we are in bullish territory. The market sentiment is bullish. If we're below it and it is moving down, then I consider that we have a bearish sentiment. And so it'll also provide support resistance because it is a very, very common moving average. And in fact, especially on daily charts, it perhaps may be the most common moving average, that and the 200 simple moving average. So as the market comes down, now look over here, first of all, this is very important as well. When the moving averages cluster together like this, essentially what that really means is literally there's been no significant change in price action over the last 15 periods or bars, 50 periods, 100 periods, and 200 periods. So this is a sign when these moving averages all cluster together like this that we've been in a consolidating market, a contracting market. And whenever that happens, then I always look for breakouts and for the market to start expanding, going into more high volatility. So basically to start a trend, and that's what happens. So we finally break out and the moving averages start to spread out. Of course, the 15 EMA will be the first one you notice. So simply because it's the most responsive, the fastest. And the others will take more time. So then when we come back up, where do we go? We go to the 200 MA. Now, if we were to go above the 50 MA, actually we come to all three of them. They're all clustered there together. But if we were to go above all three, then my reading on the market would be, okay, the market participants have not really committed to a bullish or bearish sentiment yet. They're testing both sides. And they tested the downside, and they were not able to maintain that with the majority of traders worldwide, and so therefore we do not have a clear bullish or bearish market. In other words, we don't have a clear trend. But that's not what happens. What happens, of course, is that it does hold as it retraces up here, the 50 period simple moving average, and bounces back down. So it stays in bullish territory. Remember, that's the line in the sand between bullish and bearish markets. So now we have a trend going. And then the longer it goes, the more the moving averages start to fan out. That's called a stacked structure. And I'm not that adamant about a stacked structure. A lot of people talk about that as being a clear evidence of trend. And my experience has been that, it's fine, but it's a late signal. By the time the moving averages all start stacking like that, it looks real pretty, but usually that's going to be coming to an end pretty soon. So it's not an early signal. And we put in our typical 5-wave pattern for a trend. That's the average trend based on the way that I measure waves. Notice, by the way, we came back up here to the 50 MA again. And then we get this. This is what I call the pinball pattern right here. So the pinball pattern is where the market gets stuck between moving averages. So it goes between the 15 and the 50 and just keeps kind of bouncing in there. That is a mini lowering of volatility. So a short-term volatility signal that we are contracting and we're looking for a move in one direction or the other. And the way I determine which way that's going to break out is to look at momentum on the next higher time frame. All right, so then we go back up, and where do we go? So now this is what you have to understand. Once you get down below that, we're looking for a down move. Now, the key is we have gone to, see, timing is a big part of it. And by the way, timing is so critical in trading. You really can't trade without accurate timing, and I do have a timing indicator that I do share with my YouTube video subscribers. So if you'd like that, just send an email to barry@topdogtrading.com, and I'll show you how to get that for free and a tutorial on how to trade that for free. But so the issue is, once we get into an average trend length, we don't expect that trend to continue anymore. So now we're going to go up, but we've got these moving averages, which provide support resistance. So it goes back up, of course. It hits the 50 EMA, and of course we have this little pinball. Next level, where does it go? Goes to the 100 EMA. Notice that it provides resistance there. Comes back down to the 50, then goes back to the 15, then comes back down to the 50. Now, here's a distinction that I make with support resistance, and maybe I'll do a separate video on this alone. This bar here is actually holding the 50 EMA as support, believe it or not, even though it's not touching it and it's below it. So look for that video. Maybe I'll do that video next. We call this the flypaper phenomenon with support resistance. So the market, basically the market is actually holding the 50 EMA here this whole time. Comes back down here. This low is simply created by just this right here. So we get a triple bottom. Market comes up to the 50, comes back down to that bottom again, comes back up to the 100. It's holding the 100. And then it comes back down to the 15. Then where does it go? It goes back up to the 200. Then it gets back down to the 50. Then it holds the 100 here. So what you're seeing is the price structure is very much determined by the moving averages. These four moving averages do provide support resistance, which provides price structure, price patterns. Now, here's another thing. I'll end with this. Something that you'll see is that a lot of traders know that, yes, these moving averages are very common, and so therefore they have a self-fulfilling prophecy. It's part of the reason they work. There's no ancient Phoenician numerology behind this or anything like that. It's just that a lot of people use them. And so what will happen, and you'll see this in stocks too, with support resistance, when people get frustrated with the market kind of just pinballing and bouncing between these moving averages, so we've been below it, and if the market really wants to go up, they kind of get frustrated with this, and they don't want to deal with this moving average. So they gap the market over it, so that they don't have to worry about people then taking profits here or shorting, and it just clears that. So now we are in what? We are in clear, bullish territory with no moving averages above us to make the market stop. And then we get again our stacked pattern here with the moving averages. So if you like this video, please understand that, yeah, it's free, but you have a moral obligation to pay it forward if you liked it by clicking that beautiful little share button below and share it with other people. Pass it forward, or pay it forward, as they say. Also, if you're watching this on YouTube, click the little thumbs up icon below and leave a comment. I really enjoy your comments, and that encourages me to continue to create more free tutorials for you. Also, I'm giving away one of my favorite trade strategies. I call it the rubber band trade. It has a super high win-loss ratio. Happy to give you that trade setup with the rules, the filters, everything. It's in a video about 26 minutes, so it's longer than I put on YouTube. I try to keep these YouTube videos to about 10 or 12 minutes. And